I want you to close your eyes for a second. Imagine it is 1998. You are sitting at your computer, the screen glowing, and everywhere you look, someone is getting rich. No, slowly. No, carefully. Overnight, your neighbor bought 3 .com stocks last Tuesday, and he is already talking about buying a boat. Everyone around you smells money. So you do what any reasonable, slightly greedy human being would do. You jump in, you buy the catchy names, the flashy logos, the companies with absolutely zero revenue, but a beautiful website. And for a while, my friend, you look like a genius. Then 2000 arrives, and the genius disappears. I remember watching the NASDAQ fall. Number 8%. Number 8%, 80%. Friends of mine, smart people, educated people, people who read books about money, lost millions in what felt like a long weekend. And the painful, almost poetic part, the internet itself wasn't a lie. The internet was real. The internet changed everything, but the greed wrapped around it created one of the biggest financial explosions in modern history. The price was insane. And that gap between a real idea and an insane price is exactly where bubbles live. So why am I dragging you back to 1998? Because when I look at what is happening in the market today, I feel something familiar in my chest. No panic, no excitement, something quieter, recognition, like when you smell a meal you haven't eaten in 20 years and your body knows it before your brain does. This time, the thing everyone is losing their minds over isn't the internet. It is AI. People are calling it a once-in-a-lifetime opportunity. Maybe they're right. Or maybe every generation says that, and every generation has to learn the hard way that John Templeton was telling the truth when he said the 4 most expensive words in investing are, this time it is different. But here's an honest question nobody wants to sit with. Is this time actually different? I've helped over 7 million people start their investing journey through my videos. That is not a number I take lightly. That is 7 million futures, 7 million families. And because of that, I am not going to stand here and sell you excitement. I am going to give you the truth as I see it. 3 hidden forces that are quietly shaping everything happening in the market right now. Why they matter more than most people realize. And most importantly, what you can actually do to come out of this stronger than you went in. Let's begin. Force 1, the Magnificent 7 and the $330 billion. Right? Now, as you read this, the fate of your investment portfolio is essentially being decided by 7 companies. Just 7. They have a name, the Magnificent 7, and they are Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and Nvidia. Together, these 7 companies now represent roughly 36% of the entire S&P 500. Think about what that means. The S&P 500 has 500 companies in it, but more than a third of its total value comes from 7 of them, and every single one of these 7 is in an all-out war to dominate artificial intelligence. So even if you think you are playing it safe with a simple index fund, you are already, right now, betting heavily on this AI race. You might not have chosen that bet. You might not even know you are holding it, but you are, and the money being thrown at this race. It will make your eyes water. Tesla is spending $5 billion on autonomous driving. And Elon Musk's I venture, Apple is spending $10.7 billion trying to make Siri sound less like a confused intern. Though honestly, that might need more than money. Meta is pouring $60 billion into data centers and the metaverse, which apparently is still happening. Google is spending $75 billion rebuilding the entire internet around AI, Microsoft is putting in 80 billion to fund OpenAI and build supercomputers. And Amazon is committing 100 billion to own the infrastructure that every other company relies on. Total, $330 billion. In 1 year, to give you a sense of scale, that single year of AI spending exceeds the entire gross domestic product of countries like Finland or Portugal. That is not investment. That is a civilization level wager. A significant part of what is keeping the U.S. economy looking healthy right now is this very spending. Remove it, and several economists believe America would already be sitting inside a mild recession. So when people ask, how long can this last? The more honest question is, what happens to the economy if it stops? Global AI spending is projected to hit $500 billion by end of 2026. Power and infrastructure costs alone could top $3 trillion annually by 2030. That is not pocket change. That is civilizational commitment. And you can understand why these companies feel. The International Monetary Fund has estimated that roughly 60% of jobs in developed economies are exposed to AI, meaning they could be transformed, reshaped, or eliminated by automation in the years ahead. Whoever cracks this technology first doesn't just win market share, they win the world. Mark Zuckerberg said something that I found remarkable. He said if Meta ends up misspending $200 billion, it is still worth it, because falling behind in this race means falling out of it entirely. This isn't just a corporate competition anymore. America and China are both treating AI the way previous generations treated nuclear weapons, as the ultimate lever of global power. Both nations are spending aggressively to make sure they hold the winning hand for ordinary investors. This creates two very different futures. If AI delivers what it promises, the next decade could look like the internet boom, but bigger, faster, more transformative. If profits don't arrive at the speed the market expects, the same stocks currently inflating your portfolio will be the ones deflating it tomorrow. The bull case and the bear case are both entirely believable. That is what makes this moment so fascinating and so dangerous at the same time. But before you ask where all this money is really coming from, that leads us directly into the second force. And this is the one that genuinely worries me, force two, the AI money machine. And why IT smells strange when I first mapped out what I am about to explain to you. I sat back in my chair and thought, either I am missing something or something is very wrong. Let me walk you through the structure first, and then I'll show you why it matters. Nvidia, Intel, and AMD design and sell the chips that power AI systems. Companies like OpenAI and XI buy those chips to build their AI models. Then you have data center operators, Oracle, CoreWeave, who also buy the chips, then lease computing power back to the AI companies. They're essentially the landlords of the digital world on the surface. This looks like a normal supply chain. Companies buy things. Companies sell things. Money flows logically from one hand to the next. But here is where it starts to look less like a supply chain and more like a carousel. Microsoft invested $58 billion into OpenAI. OpenAI then paid that money back to Microsoft to use their cloud services and data centers. Microsoft used that money to purchase more Nvidia chips. Nvidia then invested back into OpenAI. Each one of these transactions gets recorded as revenue. Revenue pushes up valuations. Valuations attract more investment. And the carousel keeps spinning. Let me put this in language that makes it impossible to miss. Imagine you and I go into the forest together. I pay you $1,000 to dig a hole. You pay me $1,000 to fill it back in. We have both technically earned $1,000 in revenue. If we were valued like an AI company at 40 times revenue, our little hole digging enterprise would be worth $40,000 each. Nobody made anything. Nothing was built, but on paper, we're both wealthy. No, I want to be fair here. These companies aren't literally just shuffling the same dollar around in circles. They're building real infrastructure, real models, real capabilities. The analogy is simplified, but the underlying dynamic where the same money flows between interconnected companies, each booking it as fresh revenue. That part is real and it is accelerating. OpenAI just announced a $300 billion deal with Oracle. Oracle responded by saying they spent tens of billions on Nvidia chips. Nvidia agreed to invest up to $100 billion back into OpenAI. But only if OpenAI buys more of their chips first. It is a beautiful arrangement if you're Nvidia. Their share price has risen over 1,600% since ChatGPT launched. They sell their chips to Microsoft, Meta, Google, Amazon, OpenAI, and Oracle simultaneously. Then they invest in the same companies buying from them. It is like a shopkeeper paying his own customers to come back to the shop and calling that marketing genius. Let me make the whole picture simple for you. Nvidia sells the shovels. Oracle provides the land. OpenAI digs the quarry. And they're all telling each other and telling you that there's gold down there. But nobody has actually found gold yet. OpenAI, the most talked about AI company on the planet, is currently valued at $500 billion. It is generating approximately $12 billion in annual revenue. It is losing money every single month. That gap between what the market believes it is worth and what it is actually producing. That is where the risk lies. No, to be honest, the AI companies still have real cards to play. Over 700 million people use ChatGPT every week. That is an extraordinary amount of human attention. And more importantly, an almost incomprehensible amount of data about how we think, what we want, and what we are willing to pay for. The day Sam Altman activates advertising inside ChatGPT conversations, recommending products, inserting brand messages directly into the most trusted interface many people now use for advice. The revenue potential shifts completely. OpenAI has also announced, perhaps surprisingly, that it will allow adult content for verified users. Whatever you think of that decision, the adult content industry is enormous, and this is clearly a revenue lever being pulled. Beyond that, the long game these companies are playing is dependency. Get corporations addicted to AI-powered workflows, make their operations structurally reliant on these tools. And then, once switching costs are impossibly high, raise prices without mercy. It is not a new strategy, but done at this scale, with this level of capability, it could rewrite the economics of entire industries. So the companies are real, the technology is real, the potential is real, but that potential still rests almost entirely on one belief: that progress will keep accelerating indefinitely. And that brings us to the third force. And the one that most investors aren't thinking about at all. Force 3, the data wall. And what happens when the latter runs out for the past several years? AI has improved at a pace that felt almost supernatural. I remember seeing the early AI-generated videos blurry, glitchy, barely recognizable as the thing they were trying to show. And then watching those same systems a year or two later producing footage that was indistinguishable from reality. Progress like that doesn't just impress people. It creates believers, and believers create markets, and markets create valuations, and valuations create risk. But here is the thing nobody's talking about loudly enough. That speed of improvement was fueled by something very specific. Vast quantities of human-generated data, books, articles, conversations, research papers, code, decades of accumulated human knowledge, scooped up and fed into these systems, centuries of thinking, compressed into training sets and consumed at machine speed. By 2027, AI is expected to have absorbed essentially all publicly available human-generated content online. Every Wikipedia article, every forum post, every academic study sitting on an open access database, gone, consumed, used. Think of it like a game of snakes and ladders. Everyone's been assuming the ladders just keep going upward forever. But you can only climb as high as the ladder reaches. Once the data runs out, once there is nothing new to consume, you stop climbing and start moving across flat ground. One square at a time. This is called the data wall, and it is coming whether the industry wants to admit it or not. If AI companies cannot find a way to learn beyond this wall, if they can't discover new sources of the kind of deep, original experience based data that human beings generate simply by living, then progress slows down. When progress slows down, the expectations built into $500 billion valuations collapse, and when expectations collapse. But here's where I want to give you an honest counterpoint, because I think it is important. Human beings never hit a data wall. Why? Because we don't just learn from consuming information. We learn by adapting. We learn from friction, from embarrassment, from stubbing our toes and remembering not to walk in the dark. My perspective as an investor didn't come from reading about market crashes. It came from living through them, from feeling the fear personally, from making the wrong call and carrying that lesson in my gut for 20 years. AI hasn't lived any of that. It hasn't had a conversation it didn't want to have. It hasn't stayed up at night second guessing a decision. It hasn't held a position that was bleeding while everyone around it laughed. And that gap between information and experience might be exactly where the breakthrough needs to happen. No, more data, different data, the kind that comes from interacting with the physical world, from genuine feedback loops, from something closer to what we call living, is scaling beyond the data wall possible. I believe it is. But I don't think it is a software update. I think it is a different kind of problem entirely, and the stock market is not currently pricing in the possibility that it might take much longer to solve than anyone is publicly admitting. SOIS, this is actually the dot-com bubble, and what should you deal? I started this whole conversation in 1998. Let me bring you back to right now and be direct with you. Is that the same as a dot-com bubble? No, exactly. The honest difference is that these AI companies have genuine utility. They're building tools that actually work, that people actually use, that businesses are already integrating into their operation. The dot-com era had companies valued at hundreds of millions of dollars based almost entirely on a catchy URL and a dream. That is not what is happening here. But does that mean there is no bubble? I think there is. And I want to be honest with you about that, because I know many of you have money in these markets, overvaluation. It is their circular revenue structures that inflate numbers. Present geopolitical frenzy driving irrational spending commitments. Absolutely. Hard limits on how quickly the technology can continue improving. Real and approaching, these are bubble conditions. They don't guarantee a crash tomorrow, but they do mean the ground is less solid than the headlines suggest. The part I genuinely cannot tell you is where we are inside the bubble. We could be at the beginning of a decade-long expansion, where the prices we see today look laughably cheap in 2035, or we could be closer to the peak than most people want to believe. Timing markets is hard. Timing bubbles is nearly impossible. Even the people who saw 2000 coming didn't know exactly when the floor would give way. So what do you actually do? First, keep investing. Don't stop. Don't freeze. If this is the early stage of a long expansion, stopping now means missing years of growth. Set up automatic monthly investments into a broad, low-cost index fund and leave them running regardless of what the headlines say. I did this through the dot-com crash. My portfolio dropped. I kept buying, and when the market recovered, as markets historically always have, those positions I bought during the fear became some of the most profitable of my life. The secret isn't picking the perfect moment to get in. The secret is staying in long enough that the moment stops mattering. The people who lost during the dot-com bubble weren't just unlucky. Many of them were over-leveraged. They were investing borrowed money. When prices dropped, they had no choice but to sell. Don't be that person. Invest what you can genuinely afford to leave alone. Second, increase what you earn. Your income is the engine of everything else. Your investment returns are the multiplier. But you need something to multiply. A promotion, a side business, a skill that the market values more highly. These aren't secondary considerations. They're the foundation. And if you can increase your income during a market downturn, you get the rare and beautiful opportunity to buy quality assets at reduced prices. That is not a crisis. That is an advantage. That is diversify with intention. The people who survive financial storms aren't the ones who pick the best single investment. They're the ones who spread their risk intelligently across multiple types of assets. My own portfolio includes stocks, bonds, precious metals, including gold, real estate, and yes, a measured position in cryptocurrency. I also hold dividend-paying stocks, and these are worth paying attention to specifically during downturns, because they continue generating income even when prices are falling. They're the investments that keep paying you while you wait for the market to remember what it forgot. Here's the most important thing I want to leave you with. A bubble bursting is not the end of the world. It has never been the end of the world every single time in history that markets have collapsed. They have eventually recovered and gone higher. The people who got destroyed weren't the ones who invested during the bubble. They were the ones who panicked at the bottom. The ones who sold when fear was loudest. The ones who looked at a temporarily falling number and decided it was a permanently broken one, understanding the forces at play. The arms raise, the circular money flows, the data constraints. These aren't things that should make you afraid. They're things that should make you informed. And informed investors don't panic. They prepare. And then, while everyone else is sprinting for the exit, they calmly walk in the other direction and pick up what the crowd dropped on their way out. That is how wealth gets built. No in the good times, in the complicated ones.